For years, we've been told that building wealth is complicated. You need the perfect investment portfolio, the right financial advisor, the latest strategy, and maybe a little luck. But just a few generations ago, ordinary families built financial security without any of those things. They weren't investment experts. Most never bought a single stock. Many never met a financial planner. Yet somehow, they managed to buy homes, raise families, retire comfortably, and stay out of debt, all on a single paycheck. So what did they know that we've forgotten? Today, we're counting down 25 money habits that helped millions of middle-class American families build lasting wealth during the 1950s and 1960s. These aren't magic tricks. They're not get-rich-quick schemes. They're simple habits that quietly worked for decades. Some of them may sound old-fashioned. Some may even seem too simple to matter. But together, they created something many families today are struggling to achieve: financial freedom. Let's begin. Number 25. Every dollar had a job. Many households didn't wait until the end of the month to see what money was left. They decided where every dollar would go before they spent it. Kitchen tables often became planning desks every Sunday evening. A notebook, a pencil, income on one side, expenses on the other. Nothing fancy. No spreadsheets. No budgeting apps. Just complete awareness. If the numbers didn't balance, they kept working until they did. This wasn't about perfection. It was about control. Because when every dollar already had a destination, there was far less temptation to spend it somewhere else. Today, most people know roughly how much they earn. Far fewer know exactly where every dollar disappears. That small difference quietly compounds over decades. Money rarely vanishes all at once. It leaks away a little at a time. The written budget wasn't simply tracking money. It was preventing those leaks before they started. Number 24. They never shopped without a plan. Imagine walking into a grocery store with no list. You wander the aisles. A promotion catches your eye. A new snack looks interesting. Something smells good from the bakery. By the time you reach the checkout, you've bought far more than you intended. Modern supermarkets are designed to encourage exactly that. But families decades ago developed a simple defense. They made their shopping list days before they entered the store. Not while they were hungry. Not while standing in front of colorful displays. They planned calmly at home. Then they bought only what was written down. The shopping trip wasn't entertainment. It was a mission. The list removed emotion from spending. And when emotion disappears, unnecessary purchases usually disappear with it. It's amazing how much money stays in your pocket when every purchase has already survived a few days of second thoughts. Number 23. They let time kill impulse buying. One of the most powerful financial habits costs absolutely nothing. Waiting. Whenever an unexpected purchase appeared, many families simply refused to buy it immediately. They gave themselves time. Sometimes 2 days. Sometimes a full week. Something interesting happened during that waiting period. The excitement faded. What seemed essential on Monday often looked completely unnecessary by Wednesday. Retailers have always understood urgency. Limited time offers. Weekend sales. Final clearance. Only a few left. The goal has never changed. Create pressure before logic has time to speak. Waiting interrupts that process. It allows your rational mind to catch up with your emotions. Many expensive mistakes simply disappear if you give them enough time. Patience isn't just a personality trait. It's a financial strategy. Number 22. They saved for predictable expenses. Every December, millions of people act surprised by Christmas. Then comes the credit card bill in January. But Christmas has never been a surprise. Neither are birthdays. School supplies. Car registration. Property taxes. Or annual insurance payments. Older generations understood something simple. If you know an expense is coming, you can prepare for it. Some families placed a small amount into an envelope every payday. Others used dedicated savings accounts. By the time the expense arrived, the money was already waiting. No panic. No borrowing. No interest charges. Instead of treating predictable expenses like emergencies, they treated them like appointments. Expected. Planned. Already paid for. Financial stress often comes less from unexpected events than from failing to prepare for the expected ones. Number 21. They occasionally lived on cash only. Once in a while, some families challenged themselves to spend only cash for an entire month. No tabs. No borrowing. No delayed payments. Just cash. Something changes when physical money leaves your hand. You feel it. You notice it. A small purchase suddenly feels more real. That's one reason digital payments often encourage higher spending. They remove the emotional connection between buying and paying. Cash restores that connection. People naturally become more thoughtful, more selective, more intentional. Many discovered expenses they never realized they had. Tiny purchases, convenience spending, impulse treats. Individually, they looked harmless. Together, they quietly drained hundreds of dollars each year. Sometimes the simplest financial audit is simply making every dollar visible again. Number 20. Raises didn't become lifestyle upgrades. Imagine getting a raise. Most people celebrate by upgrading something. A nicer car, a larger home, more expensive vacations, a few more subscriptions. Soon, the raise disappears. Not because income stayed the same, but because expenses grew just as quickly. Earlier generations often made a different decision. When their paycheck increased, their lifestyle stayed exactly where it was. The extra income never became spending money. It became savings, mortgage payments, emergency funds, future security. They had already learned to live comfortably on their previous salary. Everything extra became an opportunity to build wealth instead of increasing consumption. Over the course of 20 or 30 years, that habit created an enormous gap between two families earning nearly identical incomes. One earned more. The other kept more. And keeping more has always mattered far more than earning more. Number 19. They made one extra mortgage payment every year. Imagine two neighbors buying nearly identical homes. Same price. Same mortgage. Same interest rate. 30 years later, one family finishes paying off their house years before the other. How? Not because they earned dramatically more. Not because they refinanced. They simply made one extra mortgage payment each year. One. That's it. Instead of making 12 payments, they made 13. And they made sure that extra payment went directly toward the loan principal. That small decision had a surprisingly large impact. Because every dollar that reduced the principal early also reduced years of future interest. The earlier you lower the balance, the less interest has time to accumulate. Many families never realized how powerful that single habit could be. They weren't trying to impress anyone. They were simply trying to own their home sooner. Number 18. They repaired before they replaced. Today, when something breaks, the first instinct is often replacement. New phone. New appliance. New furniture. But earlier generations viewed things differently. If something could be repaired, it deserved a second life. A broken chair was tightened. A lawn mower was repaired. Clothing was patched. Furniture was reupholstered. Every repair represented money that could stay invested in the family's future instead of disappearing into another purchase. Repairing something wasn't just practical. It was profitable. Number 17. They planned meals before they bought food. Every week, many households decided exactly what they would cook before they ever entered the grocery store. Monday's dinner became Tuesday's leftovers. Wednesday's vegetables became Thursday's soup. Very little was wasted. Without a plan, something predictable happened. Everyone got hungry. Nothing was prepared. The easiest solution became the expensive solution. Planning eliminated that decision. The ingredients were already waiting. The meals were already chosen. The budget stayed intact. Number 16. They treated repairs as investments. They understood the difference between cost and value. Spending $20 repairing a washing machine instead of buying a new one wasn't an expense. It was money saved. Small repairs. Routine maintenance. Basic upkeep. Over decades, those small decisions added up to thousands of dollars that never left the household. Number 15. Extra work had one purpose. When people took on additional work decades ago, it wasn't usually to buy more things. It was to become debt-free faster. Weekend jobs. Seasonal work. Helping neighbors. Every extra dollar went toward paying down the mortgage or building savings. The household never became dependent on the extra income. Once the goal was reached, the extra work stopped. Number 14. One reliable car was enough. Many households delayed buying a second vehicle for as long as possible. One dependable car served the entire family. Insurance, fuel, maintenance, registration, repairs. Avoiding those costs allowed thousands of dollars to be redirected toward building wealth instead. The goal wasn't to own more things. It was to own fewer obligations. Number 13. Children learned money by participating. Financial education began at home. Children earned money, saved part of it, spent part of it, sometimes helped the household. They learned that money required effort. That saving came before spending, and that financial security was built one decision at a time. Number 12. They saved for property taxes all year. Large bills didn't create panic. They created preparation. Every week, a small amount was set aside. By the time the bill arrived, the money was already waiting. No loans. No credit cards. No stress. Number 11. They reviewed their expenses regularly. Insurance, utilities, service contracts, anything that renewed automatically. They reviewed everything every year or two. Small savings repeated year after year became surprisingly valuable. The biggest financial leaks are often the ones that repeat every month without being questioned. Number 10. Vacations didn't create debt. Families relaxed without financing the experience. Picnics, camping, visiting relatives, day trips. The memories lasted. The debt didn't exist. A vacation should refresh your life, not delay your financial goals. Number 9. Small utility savings became big wealth. Turning off lights, lowering the thermostat, drying clothes outside. Each decision saved only a little, but repeated every month for decades. Those little savings became thousands of dollars. Wealth is rarely built through one giant decision. It's built through thousands of small ones. Number 8. Cars were transportation, not status. Cars solved a problem. They were never meant to prove success. Families bought reliable used vehicles, paid cash whenever possible, then drove them for years. They refused to borrow heavily for something that lost value every year. Transportation solved a problem. Ownership built freedom. Number 7. They protected themselves from other people's debt. Many families refused to co-sign loans. Not because they didn't care, because they understood the risk. Someone else's debt could quickly become their own. Helping family was encouraged. Taking responsibility for someone else's financial decisions was not. Number 6. They saved before they spent. The paycheck arrived. Savings came first. Mortgage came first. Emergency fund came first. Everything else adjusted afterward. The order mattered. When savings came first, they happened. When savings came last, they usually didn't. Number 5. Family was the first financial safety net. Long before online lenders, families helped each other through difficult times. Neighbors supported neighbors. Communities solved problems together. Strong relationships often became one of the most valuable financial assets a family could have. Number 4. The mortgage came before everything else. Every payday, the mortgage was paid first. Not because anyone forced them. Because every payment moved them one step closer to complete ownership. Housing security came before convenience. Long-term freedom came before short-term pleasure. Number 3. They kept their biggest goal visible. Many families wrote down exactly what they were working toward. A paid-off house. A savings goal. A retirement date. Seeing the goal every day made every financial decision easier. Progress became measurable. And measurable progress became motivating. Number 2. Avoid debt whenever possible. Borrowing wasn't considered normal. If they couldn't afford something, they waited. If they wanted something, they saved first. Debt wasn't viewed as freedom. It was viewed as an obligation against future income. Many older Americans described becoming debt-free as one of the happiest days of their lives. Not because they suddenly became richer. Because they became freer. Number 1. Spend less than you earn. Every habit we've discussed leads back to one simple principle. Spend less than you earn. The difference between income and spending becomes savings. Savings become investments. Investments become wealth. Previous generations didn't focus on looking wealthy. They focused on becoming financially secure. Those are very different goals. Looking back, it's tempting to think those families succeeded because life was easier. In many ways, it wasn't. They faced recessions, inflation, layoffs, medical emergencies, unexpected setbacks. What made the difference wasn't perfect circumstances. It was consistent behavior. One careful decision became another. One extra payment became another. One avoided debt became another. Eventually, those ordinary decisions created extraordinary results. A paid-off home. A comfortable retirement. The freedom to walk away from work when they were ready. Today's financial world looks very different. Technology has changed. Banking has changed. Investing has changed. But the principles that build wealth haven't. Spend less than you earn. Save consistently. Avoid unnecessary debt. Buy with purpose. Think long-term. These ideas have survived every generation because they aren't based on trends. They're based on human behavior. And perhaps that's the biggest lesson of all. Wealth isn't built by making one extraordinary decision. It's built by making ordinary decisions extraordinarily well. Thank you for watching. If you enjoyed this video, don't forget to subscribe for more practical lessons on retirement, personal finance, and building long-term wealth. I'll see you in the next video.